So in this video, we're going to talk about conventional loans, what they're all about, how much you can put down, what kind of credit score you need, what kind of income levels you need, what's a debt to income ratio that you need, and why they're a really good loan option if you can qualify. So let's get into it, conventional loans. So, the first thing, about any loan when you're going to a lender, let's assume that firstly that you've done that. You've gone to a lender and they've got you pre-approved. And if you're not sure how to do that, well, check the link right above. I'm going to link to a video where I go over all of that. Getting a mortgage 101, check that out. First thing about a conventional loan you're going to consider is your credit score. The credit score you're going to need is you're going to need a 620 or above. If you don't have a credit score above 620, basically you're not going to be approved. And in that case, you might look at other options such as FHA loans. The main thing to know about credit scores and a conventional loan is the higher your credit score is, the better it's going to be for you with conventional financing. And that's because the credit score is kind of tied into the interest rate that you're going to be paying on your mortgage. So the way that works is the higher that your mortgage interest rate is, means your monthly payment's going to be more. The lower the credit score is, it means you're going to be a greater risk to the lender of maybe defaulting on the loan or not paying the loan off. So for that reason, the higher your credit score is, the lender's willing to give you a better interest rate to make the loan, better terms. So that makes your monthly payment less. You actually pay them back less money over the life of the loan. Now, maybe you've gotten a credit score, you did a credit score check a while back, and maybe your credit score wasn't over 620, but maybe you've been working on it. So, before you write off a conventional loan as an option, if that's the case, you should always go anyway and with the lender and make sure, get them to check your credit score as well, because maybe you may find that you actually do fit into the program and your credit score is over 620. Credit score is something you really want to be paying attention to if you're thinking about buying a home, and you want to be working on making your credit score as good as possible. The better your credit score, the better it is, because you have a lower interest payment. So that's the first criteria. And at this point also, if you're finding this information helpful, hey, do me a favor, smash that like button for me, would you? Hit the like button and maybe hit the subscribe button. That way you can stay tuned for more videos, relating to everything to do with real estate. And so, let's move on to the next major criteria in a conventional loan. Looking at credit scores, number one, the next thing is going to be a down payment. So the great thing about a conventional loan is you can put down as little as 3%. For a $100,000 house, that's $3,000. For a $200,000 house, that's $6,000. $300,000, that's $9,000. $400,000, that's $12,000. And for $500,000, that's $15,000. Well, that's really awesome. People often think you have to put 20% down. And just to give you an idea of the difference, if you were putting 20% down and that 20% was $15,000 down, that means your total loan amount is $75,000. You're putting $15,000 down for a $75,000 loan at 20%. But for the 3%, that same $15,000 down gets you $500,000. That's a huge difference. The difference between $75,000 and $500,000. So it's a good deal. So that what that does, it really helps. It makes it easy for people to get into the housing market, to get in, get a real estate footprint for yourself. So that's a great deal. The flip side to that is the less that you put down, what they really want to do is for you to put down as much as you can. They would actually prefer you to put 20% down than 3% down, because it's a signal that you're going to be a low risk, that you're going to be a good client, and you straight away you get some equity in the place. So the caveat is, if you can put more than 3% down, you should try to do that. There's a bunch of reasons, and one of them is if you put just 3% down and you have a credit score that's kind of low, it's around 620, down the lower end of what they require, you're going to get a higher interest rate on your mortgage, which means your monthly payments are going to be, they're just going to cost more. So, if you put more money down and you've got a slightly higher credit score, that means you're going to get a lower interest rate. So that's a good deal. That means your monthly payments are smaller. So just take that all into consideration. When you're thinking about a conventional loan, how much you want to put down, what your credit score is. Try to think of putting down more rather than less. Because here's the cool thing. If you do that, you're actually going to save yourself money in the long run because you're going to have a smaller monthly payment. That's a good deal. Point of how much money you could put down. Let's say you want to put the minimal amount down because you don't have enough for a big down payment, like a 20% down payment. Let's say you're just going to thinking of putting 3% down. Let's say your credit score is, in the 600, in the 600s and maybe close to 620. Well, in that case, you probably do want to have your lender do a comparison between, what's going to be my monthly payment in a conventional loan at 3%, 3% down with this credit score around 620, as compared to, say, an FHA loan where I actually have to put 3.5% down. You may find that your monthly payment will be considerably less using an FHA loan in that instance than it would be in a conventional loan. So you may end up paying more in a conventional loan in your monthly payment. So that's just a point of consideration, talking about down payments and how much you can put down and what your credit score is. So they're the first two main criteria and requirements that the lender's going to look at: credit score. What is it? How high is it? How low is it? And the down payment, how much you're willing or able to put down. The next thing we can talk about in a conventional loan is what's called insurance, mortgage insurance. So in a conventional loan, they're going to call that a PMI. That's going to be private mortgage insurance. And if you're putting less than 20% down, you're going to be required to take out PMI, private mortgage insurance. So, what does that do? Well, private mortgage insurance, if you think about it, it's kind of like what it sounds like. It's an insurance policy for the lender that, let's say you default on your loan, which means you stop making payments, and even, to the point where you can't finish the loan for some reason or other, that they're going to get the mortgage payments that you failed to make. So they're going to get their money back. So that's basically what that is. And there's a main difference between a conventional loan and FHA loan at this point. The private mortgage insurance is something that you can remove from your loan once you've reached about 20% equity. So, let's say you put 10% down, and then that means you've got another 10% of the balance to put down or to pay off. And at that point, when you get to 20% down, let's just use a figure of 500,000. 20% of 500,000 is going to be 100,000. So when you've paid off, you've got $100,000 of equity in that $500,000 home. You can go to your lender and ask that they remove the private mortgage insurance from your monthly payment, which they will, and at that point it means your monthly mortgage payment is going to decrease. So that's a good deal. But if you're not putting 20% down, you're going to have private mortgage insurance as part of your monthly payment, which means your monthly payment's obviously going to be more than when you don't have it. So, that's a consideration, but there's no choice in that matter. If you're putting 3% down, 5% down, 10% down, they're the typical amounts people put down. You're going to have private mortgage insurance. You go to a lender and they say, you don't have to pay private mortgage insurance with us even if you put less than 20% down. You need to be wary. That's a red flag, because they may well be misleading you, because you should know they will be charging you private mortgage insurance, but instead of calling it private mortgage insurance, what they're probably going to be doing is they're going to be charging you a higher interest rate and that's where they'll actually fund their own private mortgage insurance, but they're not going to be telling you. And they might do that to make the loan seem more attractive, so that you get a loan with them rather than someone else. So that's just a little side note for you. You have to be wary of that. Okay, so there are three things we're going over. There's a couple more we need to talk about: conventional financing. We talked about credit scores. We talked about down payments. We talked about private mortgage insurance. The next thing is to talk about, here's an interesting fact about conventional loans that say different from FHA loans, is an FHA loan has a restriction in that you can only use that loan for a residence that you're going to live in. It's going to be owner occupied, in other words. So that's not the case with a conventional loan. You can get a conventional loan for a house you're going to live in, but you can also get it for an investment property. So you could buy 2, 3, 4, however many homes you can afford with conventional loan financing. Of course, in that situation, with your first conventional loan, if you're using it for a residence you're going to be lived in, which the term they often use is owner occupied, as your primary residence, you can put down as little as 3%, 5 or 10% or 20%. But if you're using a conventional loan for a secondary home or an investment property, you're required at that point to put 20 to 25% down as your down payment. So in other words, you can't put a minimum like 3% down payment down. So if you're using it, that is an advantage. You can use it for multiple homes, but apart from your primary residence, where you can use the minimum of 3%, on all the other ones you're going to have to use 20 to 25% down. Talk about in terms of conventional financing is going to be what they call a DTI, that's the debt to income ratio. So what's all that about? Well, it's about like what it sounds kind of like, debt to income. What are the levels? You can think of it as a seesaw. Do you have more debt than you have income? Well, no one's going to finance you for a loan. But let's just use some round numbers. Let's say you make $100,000 a year. The number that's going to be important to you for conventional financing is 43%. And what that means is, if you make $100,000 a year, you can't have more than 43%, which is in this case $43,000. And then if you want to equate that, on another level, let's say you're making $10,000 a month. Then out of that $10,000 a month in a conventional loan, you can't have more than $4,300 of that $10,000 of debts that you're going to be paying, and that will include the mortgage that you want to get. So the way they usually calculate that is, after you've done your credit report, when they run that credit report, they're going to get a list of all your liabilities. So they're going to see, well, how much do you own on these credit cards? Maybe you have a car loan, maybe you have a student loan, maybe you have some medical loans or something of that nature. And so they're gonna know the total amount of debts that you have to pay every month. And then they're just going to do a simple equation of, well, let's say it's $2,000 roughly that you own every month, and you make $5,000 a month. Well, that only comes to 2 out of 5. That's going to be 40%. So you're in great shape. But if you were paying $3,000 a month and your monthly income was $5,000, then that's 60%. So it's not going to work. So you want to speak to a lender who can help calculate your DTI. If you try to do that yourself, you can do it on a rough level, but it may not be exact. So you're better off going to a lender and asking them, and they'll give you an exact measurement of what it is and where it's at. And if it's not in the right range, you can just work on improving that until you get it in the right range, and then you can get approved. Having said all that, we're talking about conventional financing. And there are some cases where conventional loans, they'll let you go up depending, if you have a really good credit score, you're willing to put 20% down or 25% down. You might be able to move up to like 49%. But the other thing is, if for some reason your debt's running over 50%, then you might want to consider an FHA loan, which we're going to go into another video, because in FHA loans, you can have a DTI of up to 57%, and that's a really cool thing to know. 57% is a lot more lenient in the FHA program. So that's another important consideration in getting conventional financing, your debt to income ratio. Then that's going to lead us into the next part of the whole criteria for getting approved for conventional loans and what they're all about, and that is your employment and your income level. So, one question is, well, is there a certain minimal amount of income that I need to earn in order to be eligible for a loan? And the answer is actually no, there's not. Most important in terms of how much money you make is how does your monthly income relate to your debts? Just what we went over, the debt to income ratio. So that's a good deal in terms of income. And the other thing is employment history. What's important that you've been working, say, for 2 years in the same kind of industry. The bank likes to see that you've been in the same kind of job, or even if it's not the same employer, maybe you're working in the restaurant industry and you've changed, employers, but you're still working in the same industry. That's fine. What they don't want to see is that you've been in a number of different jobs in different professions in a short space of time. They want to see that you have some consistency, and a 2-year period is the period that they use as a measure. So one more criteria in talking about conventional loans is after the income is your assets. That's a really important part. So they're going, a lender, after you've been pre-approved, they know your debt to income ratio, your employment histories. They're going to look at how much money you have, basically, whether it's in a bank account, whether it's in an IRA or a 401k, or you've got investment accounts with Charles Schwab or something of that nature, or even if you have a gift available from a parent or something like that. They want to know, a lender wants to know that you have a certain amount of cash reserves before they lend you the money and get you involved in a real estate transaction. And the reason is fairly simple, is that to get a real estate transaction completed, you need some cash reserves, one for a down payment and also for closing costs. And a key part of closing costs is what they call prepaid costs. And prepaid costs are basically, you're going to be required, let's say you get into a real estate transaction, you're going to buy a home for $300,000, and then you figured out what your loan payment is. Maybe your loan payments somewhere around $2,000 or something like that a month. Well, there's a number of parts of the payment. They call it the PITI, and that stands for principal, interest, taxes, and insurance. They're the 4 main key elements of a loan of a monthly mortgage payment. The principal is the amount of, if you owe the bank $300,000, and every month you're going to be paying so much of that. Well, a big portion of that payment is going to reduce the amount that you owe them of the $300,000. Then the interest is the money that they're charging you. Obviously, for the money, that's the money they're going to make for themselves. And then the taxes, obviously, every year, every property has so much taxes, and they basically put the yearly amount into 12 installments. So each month you're going to be paying the monthly installment of the yearly taxes. And finally, insurance. There's a number of insurance. First of all, you might be paying a private mortgage insurance, but separate to that, you're going to have to pay homeowners insurance. So in the case of, a natural disaster or something, you have to have insurance to completely rebuild the house so it's as it was in the condition as when you bought it. So what they often do when you go to a process of closing a transaction on a real estate deal is they make you they call it impounding. They want you to pay ahead of time, maybe at least 2 months, even sometimes more, mortgage payments. So in other words, if your mortgage payment was $2,000 a month, they want to see that you have, say, $4,000 in the bank separate from what you need for your down payment, so that you have 2 months already in the bank of your mortgage payment ahead of time. And they actually will, that'll be actually part of closing costs, where they will actually impound it and take that as part of your closing costs. So, they're the reasons why your assets are a part of the equation of getting you approved for a loan. The bank wants to know you've got that money, you can get the down payment, you've got a couple months of the PITI, the principal, interest, taxes, and insurance that we can take out, so you're good to go. The last thing to think about is, well, what's the maximum kind of amount of a loan that I could get with a conventional loan? Because conventional loan does have a limit on how much you can take out as a loan, and that amount right now is around $726,000, $200. So it's just over $725,000. So that doesn't mean that that's the amount that you could buy a property only at $726,000. Let's say you want to get a home for $900,000. And you're approved for a loan for $725,000, well, that means you have to come up with the rest of the money, which would be $175,000 in a down payment. So you could come up with the rest of that money, you get a loan for the $725,000, you put cash down for the rest, there's your $900,000. So that's kind of the way that all works, and that's the maximum amount you could get a loan for. So, I hope that was helpful. That's the basic points of what's a conventional loan, what are the basic kind of terms, what are they looking for, so I hope that was helpful for you. The other major ones that you may want to consider are FHA financing. If you're a veteran loans are really a great deal too. And, if you check out the links above, because I do go into both those in other videos. And for the moment, if you do have a question of any kind, please leave me a message. I do like it when you message me, because sometimes messages have interesting questions, and sometimes I'll just make a video to answer the question, because sometimes the questions are really good. And if not, if I don't make a video, I'll always try to give you an answer anyway, just to be helpful. And the reason for this YouTube channel is more like educational purposes, to help people learn about the real estate and everything related to real estate. So if you have found it helpful in any way, hey, do me a favor, hit that like button, hit the subscribe button, so you'll stay tuned for more videos. And I appreciate you watching, and stay tuned for the next video.